RMD panic that keeps retirees up at night. The fear that required minimum distributions could significantly impact your retirement through higher taxes. It primarily impacts a relatively small percentage of retirees with very large pre-tax balances. And today I'm going to show you exactly why the RMD fear may be overstated for many retirees or what you should actually be focused on instead. Hi, I'm Scott O'Connell with Tactical Investment Advisors, and I've spent years helping retirees navigate the tax side of retirement. What I see constantly is people making major financial decisions based on RMD fear that simply does not match their reality. Here's what we are covering: the math behind why RMDs only create a real problem for a small fraction of retirees, what has changed that makes RMDs far less threatening than they used to be, and what you should actually be paying attention to instead. Let's get into it. The conventional wisdom says RMDs are this ticking time bomb sitting in your IRA. If you hit 73, the government forces you to withdraw money, your tax bill explodes, and suddenly you are paying more in taxes than you ever did while working. Financial media loves this narrative because it keeps you clicking, watching, and worried. But here's what they will not tell you. For this to actually become a catastrophic problem, you need an enormous pre-tax balance. Here is exactly what that looks like with real numbers. The RMD percentage at age 73 is about 3.77% under the current tables. So if you have $1 million in your IRA, your required distribution is roughly $37,700. Now, add that to your Social Security income, maybe $30,000 for you and $20,000 for your spouse. Your total income is around $87,700. For a married couple filing jointly, that still falls within the lower to mid tax bracket. And remember, that is after your standard deduction. You may still be in a relatively moderate tax bracket depending on your situation. So where's the tax bomb? It is not there. Here's the number that changes everything. For RMDs to push you into a painful tax territory, it typically requires significantly larger pre-tax balances, often in the multi-million dollar range depending on your income sources. And that level, yes, your RMDs become significant, but that describes a relatively small slice of retirees. So if you're watching this video worried about RMD devastation, ask yourself honestly, do you have several $1 million sitting in pre-tax accounts? If not, the RMD monster everyone warned you about probably is not your monster. And that realization alone might be worth more than any tax strategy. Now, here's what most people miss entirely. The RMD rules have shifted dramatically in your favor, and most planning advice has not caught up. 3 specific changes. Change number 1, the standard deduction. Back in 2017, the standard deduction for a married couple was $12,700, and in 2026, it is up to $32,200. That is roughly $19,500 more income you can receive before it becomes taxable. Think about what that means for your RMDs. Change number 2, the starting age keeps moving. The RMD starting age used to be 70 and a half, and then it moved to 72. Now it is 73, and it's scheduled to move to 75 in the year 2033. Every year they push that starting age back. That is another year your money compounds, tax deferred. Change number 3, the percentages dropped. The IRS updated the life expectancy tables in 2022, which means smaller required percentages at every age. At 73, you used to have to withdraw about 4.05%. Now it's 3.77%. On a $1 million IRA, that is nearly $3,000 less you were forced to withdraw every single year. Higher standard deductions, later start age, smaller required percentages. RMD landscape has shifted dramatically in retirees' favor. Now, if you are realizing that you have been losing sleep over something that does not actually apply to your situation, you are not alone. This is exactly the kind of thing we help clients sort through at Tactical Investment Advisors. If you want to see what RMDs actually look like in your specific situation, book a time with me. Link is in the description below. Now, I know what comes next. Someone says taxes have nowhere to go but up. Politicians are going to raise rates. Fair concern. Here's the reality. According to the Pew Research, 56% of Americans already believe they pay more than their fair share of taxes. Broad-based tax hikes are politically unpopular. What we are far more likely to see is what I call shadow taxation, which is inflation, benefit phase-outs, IRMA surcharges. Those are real. But income tax rates doubling overnight and destroying everyone's retirement, that is speculation dressed up as planning. Here is the irony no one talks about. The people who should actually be concerned about RMDs are not panicking about RMD. They have several $1 million in pre-tax accounts and teams of advisors managing the situation. Meanwhile, the retiree with $800,000 save is lying awake convinced RMDs will bankrupt them. It is a complete mismatch between fear and reality. And that mismatch is leading people into strategies they do not actually need. So what should you actually be doing? Well, there are three things. First, understand your real tax situation. Pull out your tax return and look at your effective tax rate, not your marginal rate. Most retirees are shocked to discover they're paying far less than they assumed. Your effective tax rate is what matters. Second, use the gap years, the 3 years between retirement and when RMDs start, or between retirement and Social Security. Those are your lowest income years. That is when strategic Roth conversions or bracket filling withdrawals can genuinely help. But whether they help depends on your specific numbers, not a generic rule. Third, stop planning for a scenario that likely does not apply to you. Yes, stress test your plan. Yes, consider what happens if taxes rise. But building your entire retirement around a worst case scenario that probably does not apply to you is not prudent planning. It is anxiety dressed up as a strategy. To be clear, I'm not saying RMDs are irrelevant for everyone. If you have a substantial pre-tax balance, if you are approaching the top of a higher bracket, if you have pension income stacking on top of Social Security, then yes, RMD planning matters for you. And even then, it is manageable. Qualified charitable distributions, strategic timing of income, coordinating with your spouse's claiming decisions. These tools exist and they work. But the real question is never how do I avoid RMDs, as you cannot avoid them. The question is how do I build a tax-efficient income plan that treats RMDs as one piece of a larger puzzle instead of the whole game. RMDs are not the entire retirement destroyer the financial media wants you to believe. For most retirees, they are simply a rule to navigate, not a crisis to fear. The standard deduction is higher than ever. The starting age keeps getting pushed back. The required percentages are smaller. And unless you are sitting on a very large pre-tax balance, the tax impact is far less dramatic than you have been led to believe. The real danger is making fear-based decisions about something that does not apply to your situation while ignoring what actually matters. Sequence of returns risk, healthcare costs, whether you are giving yourself permission to actually enjoy your money. If you want to see how RMDs fit into your overall retirement picture and whether you should actually be worried or not, there are links in the description below. See you in the next video.